really the government is getting a lot more tax money because it's more condensed than the planning that people were used to be able to do things. Hi, Jeff Marsanti, the Plain English Attorney, and welcome to today's videos on IRAs and trusts. Is it a tax mistake? And this is coming from some clients who had some questions on why certain terms about the distribution of their retirement accounts, why wasn't it in the drafts of the Revocable Living Trust? And I think it's a good way to explain part of trust funding and why putting accounts into a revocable trust or making the trust the pay-on-death beneficiary may or may not be a good idea. So let's run through the different ways that we do planning with retirement accounts, specifically because they have tax implications. So before we really get underway, do us a favor. Go ahead and click the subscribe button so that we can keep this channel growing and get this information out there to the people for free. So just to start out, when you're doing a solid, coordinated plan using a revocable living trust as the way to avoid probate, you kind of want it all together. So is it a tax mistake to do that? So it's a way to avoid probate. It provides multiple inheritance contingencies. This is very, very important because sometimes I end up with financial advisors and other professionals say, oh, don't worry, you don't need to do a revocable living trust because our accounts are beneficiary driven. Well, wait a minute. What happens if the first person you put dies? Oh, well, I want it to go to their kids. Well, all right, you can put that in there, but there are now no trustee oversight for younger or vulnerable beneficiaries. Well, what if they die? Well, then usually by that time you're kind of lost and the beneficiary designations can only be so precise. So the revocable living trust can contain all of those different comprehensive plans in a way that brings it all together. So typically, the revocable living trust is the way to make sure that your assets get distributed the right way and younger beneficiaries have trustee oversight, or even if they're considered disabled or Medicaid is their health insurance, that you're not going to stop those benefits. So yeah, the revocable living trust is the focal point. If you think it's important for educational videos like this to get out there, then please help us out by subscribing to the channel. It's the center, the core of the plan, which lays everything out. So yeah, you want everything to run through the trust except if there's some overriding reason. And a tax hit that is severe could be a really big overriding reason. So let's just talk about what if there is a specific, say, a life insurance policy. Okay, and this comes up particularly with blended families. Well, I've got my kids, they've got their kids, but I've got this policy. I want to treat all the kids equally, except I want this one policy to go just to my kids. All right, that's fair. If you put that into the trust, that policy number, whatever, with such and such a company is to be allocated only to these beneficiaries. Now it comes under the trust jurisdiction. It goes to those beneficiaries, but we also have the age limits. If they become disabled, and all those protections are in there. Well, great. That's life insurance. There is no tax consequence. So that's fine. If we're talking about retirement accounts, now there is a tax consequence. Well, let's talk about the other thing. What if they don't need those protections? And you just want it to go to them directly without trustee oversight. And maybe it's not a huge amount of money that could either disrupt their life or significantly have a loss of the money that's supposed to be part of their inheritance. I see this all the time. It's 3 kids. It's a $50,000 policy. The bulk of what they're getting is going to be through the trust or through some other means that's protected. All right, let's give them that. Even if they just blow the money, they take whirlwind vacations and spend it all. Look, then it's fine. It's not part of the revocable trust plan. But let's go specifically in talking about retirement accounts and what that really means. So retirement accounts are taxable if they are moved into a trust. So this is another discussion that I frequently have with my clients once we have the trust set up and we get to the funding meeting, and it's all right, so this account needs to be moved into the name of the trust. This account moves into the name of the trust. We need this life insurance payable to the trust. Well, and we've got these retirement accounts. Here's what we do. Well, wait a minute. Why don't those go into the trust? It's because the government considers it a withdrawal. Retirement accounts are for individuals, for them to put away money, get tax deductions. It grows tax deferred, but when you pull the money out, it is 100% income taxable for whatever you withdraw. And if you withdraw it before 59 and a half, they're going to throw penalties on it. All right, well, we don't want that. So what exactly do we do? You end up changing the beneficiary. So what about inherited retirement accounts? Well, they can only be in trusts that meet stringent tax code requirements if it's going to be treated as a person, and we'll get more into that in just a bit. So the inherited retirement accounts, yeah, they can go into the trust, but the revocable trusts typically aren't going to have those very specific code requirements. And really, why aren't they in there? It's confusion. There's just an awful lot of confusion around it. So the estate plan is enacted with those retirement accounts through the beneficiary designations. So that's really where it's at. You don't change any ownership on retirement accounts. You change the pay on death beneficiaries. Now we're going to start running through the different options, but let me first say, if it's very typical for spouses to name each other as the primary beneficiary, well, what are the tax implications of that? Spouses get what's called a spousal rollover. So basically, they can do an IRA that's a rollover IRA, and now they take it out on their schedule. There's no condensed 10-year schedule, as we'll see. They can take it out over their life expectancy, just as if it were their retirement account. If it's not going to a spouse, now we're talking about everybody else. There's going to be this 10-year rule if it's going to an individual. So the options for beneficiary designations, these are really the big 3 that I talk about with my clients, and there are lots of different ramifications for this on the tax end particularly. If you name the revocable living trust, okay, it can go into the revocable trust. It's got the different protections. You can name the beneficiaries directly. All right, that's bypassing the trust and just going right to them, and then they do what they want with the taxes. But then the third option is IRA trusts. And these have some significant advantages if it fits what you want to have happen. So let's talk about these in turn, the 3 options. So what if the trust is the beneficiary? Right. If you're naming the revocable living trust as the beneficiary, I typically, just to emphasize the point with my clients, I pound on the table and it's taxed all at once. Well, actually, the accountants tell me the accountants tell me it's a 5-year distribution. So it's not all at once, but it's not 10 years. It's 5 years, and it's got to be taken out on an even schedule. So wait, there's other taxes, there's other ways to handle that. Yeah, we will get to that. But the big downsides, all of those protections for the trust, that's there. So you've got the trustee overseeing it. You've got your age limits. If the beneficiary is disabled, okay, you're putting into the revocable trust all of the correct provisions to keep it in trust and protected so it doesn't end up disqualifying them and getting them kicked off of benefits. So there are a lot of advantages to having the trust be the beneficiary. However, again, there's that 5-year even distribution. If it's $500,000 per beneficiary, well, now you're talking about $100,000 of taxable income per beneficiary, and that's not even accounting for any kind of growth. So that's $100,000 in each tax year. Well, are there other tax options? Yes, there are. So let's get to the next one. The beneficiary is named directly. So now the beneficiary can set up what's called an inherited IRA. So the money goes from the deceased person's retirement account into the inherited IRA, and it can be taken out over 10 years and taxed as it goes along. Here's another big thing about this. When it comes to inherited IRAs, you don't have to take any amount out in any given year. It's not like there's a required distribution. There's nothing mandating that it has to be done evenly. Well, okay, that could be a big advantage. Now, the reason this is set up the way it is and the way the government kind of explained it, really the government is getting a lot more tax money because it's more condensed than the planning that people were used to be able to do things when it would go out over their life expectancy or the deceased person's life expectancy. All right, well, what happens? If you have someone whose income and compensation is based upon like sales, if they get sales commissions, if they get bonuses on a good year, great. All right, so if in one year there's a lot of compensation, if they take money out of that inherited IRA, it's at their top tax rates. Well, maybe they don't want to do that. Next year, something happens in the economy or something happens in the company, something happens with sales, it goes way, way down, and now their compensation and bonuses is really way, way down. All right, they can afford to take out more because it's still in the lower to middle tax brackets. So they're not getting hit as hard on the taxes. The whole thing is it's gotta all be out by the end of the 10th year. If not, it's automatically coming out. And if you just leave that $500,000 in there, it's a $500,000 tax bomb. So the inherited IRA is that you're naming the beneficiary directly. That's for people who are going to do the right thing and handle things appropriately. Some of my clients, if it's their kids, they're all financially responsible and they're older, they can manage this, they know what they're doing. All right, maybe that works. You can do that outside of the revocable living trust because they don't need those protections. It's not a weird thing if I have a client with 3 children and they're all very responsible and they're responsible enough that they're going to name them as the first, second, and third listed trustees in their trust. Yeah, they're financially responsible. So that makes sense. Well, what if you absolutely want the trust protection and you absolutely want the 10 years? Well, now we get to the third option. This is where we're having IRA trusts named as the beneficiary. So in this diagram you're seeing, if you have 3 kids, it's going to be 3 IRA trusts. So so this is all set up. The retirement accounts are split evenly among those IRA trusts, or whatever percentage you wanted. Let's just use the one child as the example. So the retirement account goes to the IRA trust. The trustee sets up the inherited IRA. And now the trustee has 10 years to take out the money and have it taxed. Now, it's coming out of the inherited IRA. That doesn't mean it has to necessarily leave the confines of the IRA trust. That's something that can be worked out with the beneficiary because the taxes have to be paid one way or another. So with the IRA trust in place, your trustee is going to have a lot more options for handling that stuff while simultaneously protecting it. So there's the age limits in addition to that trustee oversight. So if they don't want the kid to actually get control of it until they're, say, age 40, but when the money goes into the IRA trust, the kid's only 25. All right, well, that money gets reinvested and stays there for that 15 years or until the trustee thinks that they're able to handle that money. There's also disability protection. So this is something that's probably worth noting. If you have 3 children, one of them is considered disabled, they've got disability coming in, there's Medicaid as their health insurance, maybe we're setting up one IRA trust specifically for that beneficiary, and the other 2 kids, well, they're responsible enough, they can end up getting that money directly as beneficiaries. Okay, great. That works very, very well. And it doesn't necessarily have to have a high dollar value before, well, that tax spread between the 5 and 10 years, it's got to be worth setting up the trusts and the administration over time. And generally, the rule of thumb, it really is going to depend on the vulnerabilities of the clients. If you don't have a significant amount in tax-deferred money, it may be overkill depending on the situation, except if you've got a beneficiary with special needs who needs to protect their benefits, then an IRA trust may become invaluable. So there's also lawsuit protection and even divorce protection, so that this money doesn't somehow get mingled and become vulnerable to a lawsuit or vulnerable to a divorce. One of the things that we have a webinar on is on in-law protection planning, so that when the parents are setting things up, they're setting it up so that their kids are not going to get the money directly. They're going to get it set up through an asset management trust and an IRA trust for the tax-deferred assets, specifically to make sure it's going to be protected from lawsuits, creditors, bankruptcy, potential disability, and divorce, so that it can't be mingled and therefore be lost. So the IRA trusts have a lot of benefits, but on the tax end, it's like, okay, you're getting the best of both worlds. But you notice, at no point does the retirement account go through the revocable living trust. So this is really where my clients that I mentioned had this question that generated the idea for this video. They were wondering, why isn't the fact that this particular account was supposed to only go to these kids, why isn't that in the revocable trust? It's because it never goes into it. It's going directly to the appropriate IRA trusts for those children that they're already setting up. So it's naming the beneficiaries correctly without anything having to pass through the revocable living trust. And that's really the key to it. When it comes to IRAs and revocable living trusts, it's not like it's never going to happen. It's, you got to take a look at the tax situation. In their particular case, we took a look at the tax situation, we took a look at the beneficiaries, and they wanted the 10-year spread, but they also were kind of keen on the protection aspect of it. Great, the IRA trust. But that's why there's nothing mentioned in the revocable trust. It never touches it. All right, so I hope you found that information useful. As I always tell my clients, please stay safe, plan ahead, and enjoy life. And whatever you do, make it a great day.